It's the least wonderful time of the year, when the tax man is calling and spirits are falling, and to the tax codes you adhere. It's the least wonderful time of the year. It's the taxiest season of all, with those painful e-files and nobody smiles, and Uncle Sam comes here to call. It's the least wonderful time of the year. And Christian and I are here for you in that time to try to take the sting out of tax season. Christian, are you ready to do this?
I'm not going to sing, but I am ready to talk.
We've got the tax anti-venom that you've been looking for on today's episode of Mortgage Monday. Christian Batchelder, welcome to Mortgage Mondays. We're talking about one of everyone's favorite topics, how to save money in taxes. I've yet to meet the human being that looks forward to filing their taxes or paying their taxes. So if you are a human being, this episode is for you. We're talking about bonus depreciation, what it is, how it can save you money, and why investors need to be implementing this strategy into their portfolio, as well as why it's one of the ways that you need to know about how real estate makes money that's not cash flow.
But before we get into that, remember when you had to pay to get a lead's phone number? It was like the dark ages until DealMachine made skip tracing a thing of the past. Now, with your DealMachine plan, you get unlimited access to phone numbers and contact information for no extra cost. That's right. Get high quality, reliable information trusted by leading financial institutions, all fully compliant with the federal do not call list. Explore over 150 data points, including age, gender, marital status, occupation, and so much more. Trust me, this is the data you need for your off-market deals. With new filters, people flags, and color-coded phone numbers, lead management just got a whole lot easier. Ready to step up your investment game? Sign up for a DealMachine plan today and gain immediate access to this unlimited treasure trove of contact information and phone numbers. Just head over to DealMachine.com/BP. Transform your lead generation and deal-making strategies with DealMachine. Sign up today and start exploring the unlimited possibilities at DealMachine.com/BP, like BiggerPockets. Now, back to Mortgage Mondays.
Christian, let's start off with a brief explanation of what bonus depreciation is.
And guys, if you're listening to this one the whole way through and then probably come back and read it again, because this is a concept that even industry veterans don't really understand fully, and they have a hard time really clarifying to clients. So David, to answer your question, bonus depreciation is this idea that when you buy an asset, okay, so we're going to speak when it regards to real estate, but really this could be when you buy a car, this could be when you buy a refrigerator for your home, right? There's multiple things that you can depreciate. The idea is that asset over time becomes less and less valuable in theory, right? Depreciation is basically the cost of use of an asset, right? The idea is this house is objectively worth less because the windows are 1 year older, the roof is older, therefore it may require more maintenance. Right? It's using up its shelf life, so to speak, right? And the typical process is you can take a year's worth of depreciation normally on your taxes as a write-off, right? That's an expense of owning that asset, right? That piece of real estate in this example. Bonus depreciation allows us to use a formula calculation that the IRS has approved and front load that into the first year. So you can take 10, 15, sometimes 30 years of depreciation all up in one chunk. And when you hear the Donald Trumps and the Kiyosakis of the world saying, I don't pay taxes, this is how they do it.
It's a Hadouken of tax savings all crammed up into a powerful ball of energy in the first year. The way that I often describe it, because depreciation as a word is confusing. It sounds like the opposite of appreciation, which is a good thing. So a house becoming worth more is appreciation. So you assume that depreciation means a house becoming worth less. It's not. It's a house's useful life deteriorating. So if you buy a car, the value of that car goes down as you use it. Well, your house is the same way, but because of inflation, the price of the house can actually go up, even though the useful life of the house is going down. Now, the benefit to investors is that the government is doing something right here, and they're recognizing that, hey, this asset that you bought is slowly falling apart over the years, so you should get to write off the part of the asset that fell apart. Just like if you owned a restaurant and you bought a dishwasher, well, that dishwasher is not going to last for the entire time you have the restaurant. It has a useful life of 10 years, so you get to write off off, say, 1/10 of that dishwasher every year. That's a hypothetical example. Please don't go hammering me. You need to talk to a CPA if you actually want to get the accurate numbers. But this is being provided to you all as a way of understanding the concept of depreciation. And like Christian said, bonus depreciation is a modification of depreciation that allows you to take a lot of that depreciation that Christian mentioned in the first year or the first couple years, which can mean big savings to somebody that's making good money and wants to write off a lot. Now, this is done through what is called a cost segregation study. Can you explain what that is, Christian?
A cost segregation study is not the actual process. I had a misconception of this when I first entered the industry. I thought the cost segregation study was the actual tactic of saving on your taxes. It's not. What it is, it's your defensive fort, so to speak. A good cost segregation study will never get used. The only time it would actually come into the conversation is in the event you get audited. You get the number that you use for your bonus depreciation from a professional utilizing a cost segregation study. That's where some, whatever their service is, a cost seg specialist would potentially go visit the house or look at pictures, and they would do all their calculations. This window, this door, this cabinet, this countertop, this bathroom, this toilet, yada, yada. They'll go through and actually itemize your property. And they will give you the calculation as to what depreciates at what rate, and they will add up all the numbers and give you your tax savings. When you go and file that on your taxes and you take $100,000, $200,000 loss in depreciation, in the event the IRS comes and says, hey, David, prove it, you say, look at this. I have a cost segregation study concluded by a professional with their opinion on the depreciation of my property. And you can have all your ducks in order, your I's dotted, your T's crossed. And that's what defends you in the event of an IRS audit questioning your bonus depreciation.
There you go. You can't just say it depreciated. You actually have to have something written down that explains what's depreciating, much like Michael Scott in The Office tried to declare bankruptcy by shouting, I declare bankruptcy. It's not enough to just say it. You have to declare it. Now, the IRS tax code gives special tax bonuses to people that are real estate professionals. And there's a definition in there. It basically means the majority of your time is spent doing real estate related activities. You got to work so many hours a year doing it. But here's what they're getting at. Normally, you can only depreciate your asset and use the write-offs against the income the asset made. Okay. So if you add up all your depreciation and it ends up being $20,000 and then your asset made $10,000 in cash flow, the $20,000 of depreciation would shield the $10,000 that you had in cash flow. And then next year, if it cash flowed $10,000 again, you'd be able to use that leftover depreciation. So you'd pay zero taxes on your cash flow. But what about the money that you made somewhere else? Well, if you're a real estate professional and you're earning real estate commissions or loan commissions or revenue from other short-term rentals or flipping houses, all these different things that people in the BiggerPockets community do, you can use depreciation from one asset to shelter the income that you made in other real estate related activities. And this is what's beautiful. This is how you hear the Robert Kiyosaki's and the Donald Trump saying that I didn't pay any taxes, because they bought enough real estate to use the depreciation to shelter the money that they made from other real estate related activities. Okay. Now, Christian, you have an example of how you did this yourself. You ordered cost segregation studies on a rental property. You had them run. You took bonus depreciation and you were able to shelter income that you made from loan commissions. Can you give us a gist of how much money you were able to save and how the process worked for you?
So guys, this is a real example. This is a property that I purchased. We're not going to say the address, but we will share the numbers. This was a cabin. As many of you guys know, I'm a short-term rental investor. This was a cabin in the Smoky Mountains. My purchase price, I'm looking at the document right here, was $650,000. Okay, that's what we bought it for. This was in 2021, I believe. So $650,000 was our purchase price. The land value in this case was $33,000. Okay, so that was just the value of the land, which means the improvements, which is the plumbing, the utilities, the structure itself, was valued at $616 and some change. Okay, so that's our improvement basis. Whenever you use a cost seg study, you can't depreciate land. Okay, land is just a flat value. You don't depreciate it. Land does not have wear and tear that's done on it. So you can only depreciate the improvements on the land. Okay, from that 616 and change valuation, my first year bonus depreciation that I realized in terms of a tax deduction was $181,000. That's the write-off that I got. And that led to a net tax savings in that state of $67,000. So let's back these numbers up. From a $650,000 purchase, I saved $67,000 in taxes, which means that property led to me saving 10% of its value in taxes my first year. So if I didn't buy that property, I'm paying $67,000 in taxes otherwise. By buying that property, I saved $67,000. I forgot the loan product that we got for this. It may have been a second home and may have been investment. Let's say it was a second home and I put 10% down, 67,000 savings to buy 650. That's almost nets out. So my first year in tax savings equaled my down payment in this case, which is incredible. I basically got a house for free.
That's what you're looking at. Is your down payment would have been $65,000, which is 10% on a $650,000 property. Your savings were $67,000. Now, here's the bad news. We have slowly been seeing bonus depreciation step down every year. So a couple years ago, you could use 100% of that bonus depreciation. Well, then in 2022, you're only able to use 80% of that bonus depreciation. In 2023, you're only allowed to use 60% of that bonus depreciation. And it was set to scale out to where ultimately it would be at zero. But Congress has recently been considering extending it to going back to 100%. And if they end up passing this bill, which it looks like they probably will, properties that were put into service in 2023 will be able to write off 100% of the bonus depreciation. Again, do you want to share a little bit about that, Christian?
If you go back and you saw, it was either on Mortgage Monday, maybe it's on the podcast, we actually expected this to happen, primarily because this is, it may sound corrupt, but this is what congressmen and women use to write off their taxes. Okay, this is by far and away the strongest tax saving strategy that is out there, specifically for real estate investors, but even compared to everything across the board, this is the strongest strategy to save on your taxes. What they just produced in Congress was a bill that says for properties purchased between 2023 and 2025, we will retroactively allow you to use 100% of bonus depreciation again. Then they're saying after 2025, it will go to zero. So let's play out two scenarios here. Number one, if investors now know they only have 2 years to buy properties where they can use this strategy, do you think that's going to be an increase in buyers or a decrease in buyers? These are buyers, and to be clear, guys, these are buyers that are not buying for cash flow. These are buyers that don't care if the property cash flows. They're trying to save, like me, $60, $70, $100, $200,000 in taxes. That's a bigger savings to them than a $500 or $1,000 a month cash flow. Okay, as David shared, this could be a decade down the line in savings that you're front loading by doing this, right? My anticipation here is that this is going to lead to buyers that maybe have been on the sidelines combined with the rate decreases that are coming in 2024, at least that we anticipate coming. On top of, if this bill goes through, now you get 100% bonus depreciation back again. It's going to be a surge of smart investors, potentially institutional investors, people who are buying for different strategies than just cash flow are going to be flooding the markets again if this bill goes through.
So Christian, who's the right avatar to utilize a strategy like this?
Yeah, the ideal candidate, as David shared, all the requirements with, real estate professional status or the short-term rental loophole. The biggest thing is somebody who makes active income. Okay. Typically, this is broken down into passive and active income on your tax returns. That's how everything is, characterized on your taxes. Passive income write-offs can count against passive income gains. So all of your real estate is in that passive section. What cost segregation allows you to do is move that passive income and count it against active income. That's your W-2 salary, your 1099s if you're a salesperson, your business owner income if you own a company. That's the goal, is to count it. In my example, when I got a $67,000 write-off, that wasn't just against my real estate earnings. That overcomes what my real estate, that property didn't net $70,000 that year. It's important that I can take that write-off and count it against my income as the owner of the one brokerage. That's the goal here. Okay. So anybody who can qualify with that material participation, with that short-term rental loophole, with that full-time real estate professional status, and has W-2 or active income is the perfect candidate for this strategy.
When you get all these pieces put together, they do form that tax-saving Voltron that can skyrocket how much money you save. Like Christian said, this can actually provide the down payment of a property. How many of you are listening to this and may have the down payment for your next property sitting in the bank account waiting to be paid in taxes, when instead you could give it to the seller of a home and own your own property? If you want to know more about Christian and I, you can reach out to us. Christian, where can people find you?
Yeah, social media, Instagram's the best place to do it. At The One Broker is my handle. Our website's also theonebrokerage.com. Little contact us now and apply now link in the top right corner. Click that, get in touch with the team.
There you have it. If you wanted to talk to me about CPA questions or anything else you heard us talk about, DM me at DavidGreen24 on whatever social media that you use. I also use Instagram the most, or check out my website, DavidGreen24.com. And if you're nerding out right now and love this stuff, well, God love you. Head over to BiggerPockets.com and check out the forums where you can find tons of content on topics like this. You can get put in touch with BiggerPockets approved CPAs. There's even books written by people like Amanda Hahn that collaborate with BiggerPockets to share tax information for real estate investors. So you can find her books or my books at the BiggerPockets bookstore. Go check that out as well. If you've got a minute, check out another BiggerPockets YouTube video. And if not, we will see you next week at Mortgage Monday.